If you owe the IRS more than $50,000, there's a huge chance that you probably have a tax lien placed on your property. Let's talk about what that means. When people hear the term tax lien, they panic instantly and it's all bad and it's all chaos. But let's just explain what that means in plain English. A tax lien means the IRS now has legal claim against your assets. If you go into bankruptcy or you sell your profits or whatever, before anyone else gets paid, they get paid first. So you can still get credit. You can still operate. But here is what matters from a secure transaction standpoint. Priority. For example, if you're trying to get something like an SBA loan, they're going to have the first position to get paid first. Most lenders want first priority. They want to be paid first, especially the federal government. So lenders now have to consider that risk, especially if it's two government entities. They talk to each other, right? So the SBA is going to say, oh, well, the IRS holds a first priority. We don't want to be second. Or do we want to be second? We have to consider the risk here. Now, if your debt exceeds $50,000 and you get it paid, let's say you get it paid to under $50,000, you can then go file to get that lien removed. Make sure you're making those payments to the IRS. Keep it active. Keep yourself in good standing, and the lien can be removed at that point. And that's why I always tell clients it's so important to address these concerns early on and to be educated when having discussions and negotiations with the IRS and when making payments and understanding what lien, levy, different exposures look like. Because once you understand what's happening, you can start putting a strategy in place to resolve it and get back in control.